Hey everyone, welcome back to my channel. In this video, we are going to talk about an important UK tax topic: how to avoid reducing your personal allowance once your income exceeds £100,000 per year. As many of you know from my previous videos, for every £2 exceeding from £100,000, your personal allowance is reduced by £1, which means once your income reached £125,140, your personal allowance is gone. But the good news is there are legal and effective ways to avoid and minimize this reduction. So I will walk you through step by step. But before going into these steps, let's have a demonstration. How does personal allowance reduce? Let's say you are earning £112,000 per annum. Now on your screen, you can see with every £2 increase in income over 100,000, personal allowance has abated by £1. Thankfully, there are number of tactics used to mitigate this quirking system, mostly by reducing adjusted net income. Now, at the end of the video, I will sum up how to calculate adjusted net income. So now let's have a look on first step, how we can avoid reducing your personal allowance. So the first option is shift your income by transferring interest and assets such as shares and properties, or by putting bank accounts and rental properties into joint name. This means that when you start sharing your income with your spouse or partner, it will automatically help you to keep your income under £100,000 threshold, and obviously which will avoid reducing your personal allowance. However, one thing you need to consider here: for married couples or civil partners, this would be cheap without worrying about capital gains tax or inheritance tax. For unmarried couples, it needs to be considered any transfers of chargeable gains as it will take place at market value. Now, moving to the next step, which is defer your income. If you expect to earn over £100,000 in current year and anticipate earning lower than £100,000 in following tax year, consider deferring your bonus or other income. This is particularly beneficial for those who is receiving discretionary bonuses, self-employed people, or company directors who can control timing of their dividends. For example, instead of taking a 5,000 bonus in March current tax year, deferring into April next tax year help you stay within £100,000 limit and retain your personal allowance. The third option is pension contributions. Now, in pension contributions, there are three main options which helps to avoid reducing your personal allowance. Number one is auto enrollment. This is when you are an employee and your earnings are over £10,000 per annum, then your employer must enroll you for pension. And when your pension arrangements are net pay, which means your pension will be deducted from gross salary and you will automatically receive tax relief at highest tax rate of income tax. This will reduce your adjusted net income, which means it will avoid reducing your personal allowance. And second option is salary sacrifice. If your employer agrees, then you can make the pension contribution through salary sacrifice, which then reduce your adjusted net income and obviously helps to avoid reducing your personal allowance. For example, if Mr. Ali's employer permits him to contribute into pension contribution via salary sacrifice, then here are tax savings which you can get. If your salary before salary sacrifice is £100,000, your personal allowance will be £6,570. However, if you agree to put a salary into your pension via the salary sacrifice scheme, then your salary after salary sacrifice will be £100,000 and you will get your full personal allowance of £12,570. And final option under pension contribution is personal pension contributions. This will help you to extend your basic band and thus avoid paying more tax. Let's have a demonstration. Let's say your income is £112,000 and you have contributed into pension pot £2,500. And now on your screen you can see the first tax computation in which 6,000 personal allowance has been reduced. However, on second screen you can see only £4,437 personal allowance has reduced. This is because £2,500 of pension contribution helps to avoid reducing your personal allowance. Now, before going into the next option, just a quick reminder, please. I have uploaded a pension series in which I covered roughly 10 major topics starting from basic to more advanced level, including what will happen to your pension when you die, how employed and self-employed people can plan their taxes through pension contribution, how to buy a commercial property through SIP, and few others. Please do watch these and leave your comments and thoughts and if you have any questions. Now coming back to the fourth point, which is charitable givings or gift aid donations. Donations made through gift aid extend your basic band and reduce your adjusted net income. Make sure you declare your gift aid donations on your tax return to benefit from the income reduction. Taking the same figures, let's say your annual salary is £112,000, it will reduce your personal allowance by £6,000. And now on your screen you can see second tax computation in which we have contributed 600 into gift aid donation, and now you can see personal allowance is reduced by £5,625. So the final option to avoid reducing your personal allowance is loss relief. The loss relief could be either enterprise investment schemes, seed enterprise investment schemes, or venture capital trust. Let's say Mr. Ali has subscribed EIS shares in ABC Limited in May 2020 and claimed EIS tax relief. ABC Limited has not been successful, and in June 2024, Mr. Ali sold shares and realizing a capital loss. Now, this loss can be offset against current year income. Now on your screen, you can see income tax relief of £8,000, which reduces the adjusted net income to £99,000 from £107,000. And if we don't use share loss relief, then personal allowance will be abatement by £3,500. So now, before concluding this video, let's have a look how adjusted net income is calculated. Total income minus charity or gift aid contributions, minus pension contributions, and finally minus trading losses. These strategies including shifting your income, defer your income, pension contribution, gift aid contributions, and finally loss relief can help you to avoid reducing your personal allowance if your income exceeds £100,000 per year. Please make sure consult your financial advisor or your tax accountant before making any big decision. And if you found this video or any of my previous videos, please hit the like button and subscribe my channel, and please leave a comment if you want me to explore any specific tax topic. So until the next time, plan smart and prosper. As always, hand ahead, salute until the next video.